Hey folks, welcome to another episode of Business Redefined, your weekly most comprehensive look at the world of business, finance and economics. We want to talk about matters markets. There's been so much noise from the public finance space and we have seen a number of developments, whether you're talking about FX, that's the foreign exchange, or the equities, that's the stock side, or as well the fixed income market where we have seen some interesting subscriptions when it comes to issuances in the bonds market. I want to delve right into this with the Chief Investment Officer from Avoca. That's Wilson Warriera. Karibu sana.
Asante.
So Wilson, let's start from here. We have seen the shilling in the recent past come under a little bit of pressure after a period of protracted kind of stability we saw right after the Eurobond. And many of us are asking ourselves, what exactly is happening in the foreign exchange market and what's driving the trends we are now seeing on the shilling?
There are two sides of this. One, after earlier in the year, in February, when we announced the refinancing of the initial Eurobond, I think at that point when you saw now the shilling turn, started appreciating. And then in coming June, we now finalized paying now the last tranche of the $2 billion Eurobond.
Yeah.
And those were good sentiments, or changed the sentiments about the market and about our capacity to refinance the government, or the capacity of the government to refinance its debts. But then in June, with now the the clamor by the young people in the nation, and also by the people to change or have some clauses in the finance bill be dropped. So what we have seen is that it brought a bit of uncertainty on one, because there was already budgeted, we look at our budget deficit. And we were working towards quite a good trajectory, towards achieving a better, or we are headed towards 3% in terms of budget deficit.
Yeah.
But now with the rejection of the finance bill, so brought a bit of uncertainties. And what you are seeing, or the reaction you are seeing in the market currently from a currency point of view, is because of these uncertainties. So what happens next? That's the big question that the market is asking.
I see.
Now, there's an appropriation bill that was already passed. We have seen now the supplementary budget. It's supposed to come and fill the gaps. So in terms of cutting expenditure, in terms of but now, as we have seen, even the discussions currently happening in Parliament, there are some areas that were proposed by supplementary budget to be, to cut expenditure, but the parliamentarians are saying, okay, wait a minute, these are a bit important or critical. They need to be funded. So this whole uncertainty of what comes out of it, by the time we are seeing the passing of the supplementary budget, what is the level of deficit? And from there, so what happens? Are we going back to the markets in terms of issuance of more bonds, or issuance of more debt to cover that? So that uncertainty is what has led to this a bit of volatility in the last 2 weeks, or the depreciation in the shilling in the last 2 weeks, and this volatility or this uncertainty may continue until we see now this question asked. What is the level at the end of this whole process? What's the level of our deficit, and how are we going to finance that deficit?
I see.
Yep.
And just for the sake of our viewers there, when Wilson talks about the deficit, that's the difference between the revenue you raise and the expenditure. And currently, based on the numbers we've seen from the National Treasury, we are looking at about 761 billion shillings worth of a deficit. Remember, initially, we were looking at 597 billion shillings in the deficit for the current financial year. Wilson, let me ask you, to what extent, because about a fortnight ago, we saw the rating agencies Moody's downgrading Kenya's rating. And the question here is, to what extent is it playing out in the investor sentiment, especially on the foreign exchange side?
It has a huge impact on two things. These markets are highly interrelated. And with that downgrade, what happened was that you could see some moves within the fixed income space, whereby the yields started spiking because there are more offers of government securities. People who are holding the government securities before are trying to exit, and this is what happens with this relating. So basically, how the international financial landscape works, especially for these the multinational capital providers, you'll find that now a certain liquidity or a certain capital flows are matched with certain risk ratings. And so when our risk rating is lowered, let's say by, the way our risk rating was lowered by Moody's to C. Yeah. So what that means is that if you are holding certain portfolios within your books, then you are looking to exit because you had held them based on a certain risk level. And now the new risk level, probably you are bound by your investment, what you call the IPS, the investment policy statement, from investing in certain risk levels. And so what happens is that now once you see these capital outflows, or people looking to liquidate certain holdings, government holdings, because of changes in risk, in risk. So what that leads to is, one, there's also a demand of dollars, because people are basically jumping from the Kenyan shillings to all different currencies that they had, the primary currencies they had invested in. So that one is also playing a huge role or a huge impact. And after that risk rating or the downgrade, that's when you saw now there was a bit of an increased volatility towards the depreciation of the shilling. So yes, I would say to a large extent, when you look at it from not only just the shilling point of view, but to the whole landscape of the capital markets and how the players in it participate and how it influences the currency on the other side, then you find that now there's that impact.
I see. Yeah. The Moody's downgrade was largely predicated on what they termed as challenges they foresee for the government to be able to mobilize resources domestically, basically telling you that the withdrawal of the Finance Bill 24, as it were, is a huge challenge, but further down the road, we see a challenge where the government might not be able to ramp up tax revenue as it would have expected. And so the question now becomes, when you look at the Supplementary Appropriations Bill, which is currently before the House, do you see a considerable effort to rationalize expenditure to equal the withdrawal we saw on the finance bill side?
Now, looking at the supplementary budget one and the areas that the government is trying to reduce expenditure on, one, you find there are a bit of contested areas, and so you don't find, areas in education,
healthcare,
the healthcare. Yeah. So they are a bit of contested. So what is the impact? Because for now, if you are not employing these JSS teachers at your first, so on one side, there's these what we call, the aspect of that budget as a government being the largest, basically the largest employer or the largest creator of opportunities within the market space. So as it's reducing its expenditure in some of these critical areas, then it's what it's doing is constraining, I'll say it's constraining a flow of funds or flow of to some of these most critically needed areas. So there's that aspect to look at it. But on the other side, now going directly to your question, I don't see as if the areas they are looking to rationalize expenditures on, that won't be enough to, one, cover the whole deficit. On the other side, we have also seen now from last year, they had over 290 billion miss in tax revenue.
Yes.
So with this year, with the market and the economy still not, the environment still not well improved, so we see that aspect continuing. And I think now from that side, that's why now Moody's rating was looking at it in terms of there may be headwinds down the road. You expect the government to find it hard to fully collect these targets that it has. It's quite an ambitious target. Then with people now being more sorting out their disapproval of government, digging deeper into, into their pockets through tax collection, then that's an issue. Yeah. And I think also the Moody's was looking at it from the angle of, now with this clamor of people pushing pushback against tax increases, then may become a perennial thing. Now that's a risk. Because now it means that if every year the government tries to introduce a new tax, a tax line, and people are against it and trying to rise against it, then that's a risk of how will then the government implement even future tax policies.
I see.
So I think now that's why the risk that Mundi was speaking about in terms of down the road, then there's a risk from government tax collections.
Okay. For all intents and purposes, we know now the government will be going a lot more heavier than anticipated on the domestic market.
Yes.
To mobilize debt, to plug in the revenue hole which has been created.
Yep.
We have seen where the yields are. And the question that emerges is, one, where do you see these yields going? Because even if you look at the short-term end of the market, which is the T-bills, they are quite high, elevated. And going forward, given that GOK will now be coming even more aggressively than earlier expected, where do you see them going?
I would say the yields, the beauty of the capital markets is that it tends to be a lead indicator rather than a lag indicator. As you have observed the last two, since the whole discussion about the finance bill started, the yields of the short-term end, looking at even like the 364-day T-bill, are up by almost 20-30 basis points. The yields in the general market, if you look at the mid of the curve and even to the long end of the curve, they have risen with a few basis points. So I would say now the market has already anticipated this. The market is guiding towards this. But do we see them rising further? I would say at this point the market is looking at even where the CBR is. That could be what would be mostly impacted. That as the market was expecting that at a given point in time, probably we may start seeing the CBL or the CBK lowering its CBR rate. That at this point now that one may put a brakes on that. So the CBK may not rush or may not be quite in a hurry to now lower its CBR rate. So it means that we may want to observe probably for longer. So it may be at higher for longer. That's an impact. We may not see a huge spike in the yields, but we may stay higher for longer. So at this point, I would say what has changed is sentiments. That the market expects the government to come in quite heavy. So the market will be holding yields at higher rates, probably not huge spike of yields like we saw last year, because at this point we are looking at the vulnerabilities we have is there was this budgeted increase in expenditure. So how are we covering it? That's a big question. And if that question is sufficiently answered, by the time we are done with this supplementary budget process, then the market may probably convince the market a bit to the rates, we may see them stabilizing are probably where they are. But we may not see them coming down faster as it was previously anticipated. So this at this point it's more of change in sentiment and the market trying to readjust to those sentiments. And as I've said, the market is a lead indicator. And so already it has shown that.
But Wilson, do you really see in the near term CBK having headroom to begin unwinding its policy, cutting its rate? And why I ask that is because last week we had the July update of the World Economic Forum from the IMF. And the IMF categorically indicated that among major economies, notably the US and in Europe, the pace of disinflation will slow down, implying inflation will not fall as fast as expected. And what would that mean? Their central banks would keep their benchmark rates higher longer than we have anticipated. Now, how would the likes of CBK be cutting their rates in an environment where the major central banks are keeping their rates elevated because the foreign exchange risk there becomes really amplified?
I would say these are now the headwinds facing CBK as it makes its policy decision, even as we head towards the end of the year. And I would say even extended. The aspect here is CBK may now be forced to maintain its rate for higher for longer. I think that's the language that we should start accommodating in all our matrices, because as you're saying, with the global markets themselves being forced to, these CBKs, these central banks being forced to maintain their rates higher, then From a currency perspective, CBK may not be incentivized to rush to, to cut its rates.
Yeah.
So it may not be very accommodating in its policy stance, for now. It may continue with the current pace. I think if you look at the language that has been used in the previous MPCs, it's, they're still in that whereby they maintain the policies and observing. And I think we'll be getting to that level of observing for quite a while.
Yeah.
So I'd say those headwinds now puts brakes on CBK in terms of what it can do with the rates for now.
Okay.
Yep.
We have seen some abysmal performance by auctions in the market in the recent past, whether it is a tap sale, which sought to raise, and actually the performance rate was about 2 or something %. And it looks to me like the market is signaling the government that there are limits to reopenings, there are limits to tap sales, because in those instances we are price takers. We want to have a fresh issuance where we actually send our price signal. And this is where I disagree with the view that the market has been leading on where the pricing should be. I actually think the market is pushing for the yield curve to tick up further. Do you see that being a challenge, especially as we start the current financial year? Because the government can't keep on reopening when it's underperforming on the reopening and tap sales.
I look at it in a different angle. The board that was being reopened then was a 1.2-year board.
Yeah.
Which, if you look at it from a fund manager's perspective or from a bank's perspective, it's almost you're taking the 364-day risk. Look at the performance in that particular week for the T-bills. And you find that now investors bid more on the 91-day. There was also low performance in the 182-day and the 364-day.
Correct.
So basically what the market was signaling was, in as much as it's bidding for government debt, but there's these, as you're saying, the rate uncertainty. The market expects rates to go higher.
Yeah.
They're not willing to commit for the given rates at these, at these levels. So that's why they are going for, for the short-term T-bill. And now, how does the government react to this? As you're asking, or as you're saying, does it now continue reopening, issuing tap sales, or does it issue, a new board? And I would say between Feb and June, the government, things had started easing up.
Yeah.
And you saw the government issue a 10-year board and actually issue a rate. So it was more confident.
Yes.
It was getting to that, to that comfort level.
The fixed coupon.
Yes. But now, the market is signaling, actually no, things are changing. The tide is changing. And so if there was to be an issuance of a new board, you see now market bidding probably at higher yields. And I think at that point, when we still have a refinancing risk, so it's more of a catch-22 to the government, to the treasury.
Yeah.
So the issue at a fixed coupon as they did last year, last time, and market bids are higher. They probably reject most of the papers, as they do at times.
Yeah.
But then that also means they don't manage to finance, and with the expanding, with the supplementary bill expanding, basically what they will be looking to borrow. So at that point, it's more of conundrum will face the market. So there will be more of a push and pull between the market and what the Treasury is looking to do. And I would say these uncertainties, you may see them playing out in different other aspects of the market, whether it's in the equity space, even in the currency market.
Yeah.
Yep.
All right. Good way to segue into the equities market, the equities being the stocks on that side. So what are some of the things you're seeing? The exchange itself has been very bullish about the sentiments we are seeing and the ranking we are seeing globally. When you look at the counters there, year-to-date performance, are you compelled that there's an opportunity there, or how are you seeing it?
Now, when you look at the equities market, there are two ways to look at it. One, it's on the companies themselves. What is happening there? Where are the opportunities within this, within these companies? And when you look at now you look at the fundamentals and you dig down to the numbers of these companies, there are opportunities. There are value that can be picked within the market space itself. And so on one side...
But that value must be skewed.
Yes. And now on the other side, there is now the larger marketplace.
Yes.
And this is whereby now the sentiments are quite dampening. And with this now dampening of the economic sentiments themselves, and then so means that now most investors, both from a retail perspective and even from the institutional investors, are not willing to take the risk in the equities market currently. And so what that's doing is in a way suppressing performance of the market itself. Risk, the sentiments that investors have towards risk.
Yeah.
It's quite a huge, plays a huge part with, with the positioning of the markets themselves. As we saw, just going back to these, using February as a very good example, that when the sentiments change about the government risk, then you saw the market actually really performing very well. And some counters are up, 20% and above. You look at the financial sector and all that. But then at this particular point, you have seen now, during all these uncertainties in the last few months, the market has in a way taken a little beating. That investors are looking at it and they are like, okay, we have to wait for how is the broader economic sector performing. And based on this broader economic sector performing, then we'll be, in as much as we love the fundamentals of certain companies, but they don't operate in isolation. They operate within this huge landscape.
Yeah. And
the landscape itself seems to be a bit slippery at this particular point in time. So until the macro issues are solved, that's why now we may see now more active engagement in the equity space itself.
Yeah.
So I'll say at this point, whatever is happening in the macro space is really feeding a lot into what is happening in the equities market. So from various point of view, yeah, there will be two counters that you're buying at very good price to earning ratios. But then on the other part, whatever happens on the broader scale, like for example, you look at the the banking stocks, that whatever is happening within the government space, I would say it's inability or it's the struggles having to pay, it's paid in bills. That one feeds to the non-performing loans that we see in the banking sector itself.
Yes.
So in as much as there's good performance within this space, but then there's this item that's pulling them down, which is the increase in the non-performing rates. And so that intertwined broader look at the market itself, that's where now I would say now the current dampened mood in the market, in the stock market, it's coming from.
Okay.
Yeah.
My final question, Wilson, is this. I've always held the view that the Nairobi Securities Exchange is largely for a dividend play, not necessarily for a capital gains play. What's your take?
For the past few years, your statements are correct.
For the past few years?
For the past few years. But I believe that can change because most of the investors who come to the market are actually looking to create wealth. And there are two aspects of how we look at it. One, what is the level of active institutional play in the market itself? I would say the institutional players have reduced the active participation in the stock market. Now, two, the retail clientele base, because of probably the poor performance of the market also in the last few years, have also reduced their participation in it. So the question is, how then do we revitalize the Nairobi Securities Exchange as an avenue for dream makers to come and get yourself invest in a company with the hope that's helping to help within your wealth creation strategy. And I think the NSC where it sits, there are opportunities both to expand the scope of the market activity. Also in terms of increasing the number of active counters. And at this point, I would posit that the NSE itself has been so much focused on the government listing of government entities. But I believe there's huge opportunities within the private space itself. So what happens towards the BD in that private space? And also, there's one area that probably NSE has lagged. There's a law that was, or a regulation that was passed by CMA back in 2017 on the depository receipts.
Yeah.
It's an avenue that NSE has really not captured. Yep. And when you look at it, the volumes that trade within this market, in comparison to the regional markets, they're quite high. There's good infrastructure for investors from abroad to come and invest, within the NSE itself. Then, for the NSE, all that it needs to do is attract these companies also from the region, who could either be listed in their regional markets, in their local stock exchanges, but will probably issue depository receipts. And all that is needed here is now the custodial banks. And I believe we have good infrastructure within the custodial banks who would be listing these shares as depository receipts in this market. So I think this is one avenue that NSE should explore towards increasing the number of listings within the market itself. And it's a big opportunity there because I believe the market is looking for one big or a few several good listings to increase the number of active counters with the market itself. There are good corporates outside Kenya who probably would get a lot of value if they found a second listing within the market itself. And avoiding the whole regulatory process of going public or doing a secondary listing, then the depository receipts becomes a good avenue. And with these, if it was to be well activated, then NSE can tap to corporates way beyond this region, and indeed become a center of pulling capital flows to the economy.
Wilson, unfortunately, that's all the time we had for in this conversation. Thank you so much for being part of it.
Thank you, Julius, for having me.
Karibu sana tena.
Thank you.
We have been speaking to Wilson Wariara from Avocap, and we've been touching on the market, starting from the foreign exchange, coming to fixed income, and closing with a discussion on equities and where this market is going. Is it one for capital gains? Is it one for dividend play? We shall wait to see how 2024 closes in terms of the uplift that investors get in this market. Stay tuned to Business Redefined for more details on this.